What's up, Neil? How's it going?
Good. How are you?
Good. We've been a little busy since our last chat. I know we got some great feedback on just kind of this format and keeping people um, in the know of what's going on at the firm and some of our thoughts. And so I thought we'd do another video together. How are you?
I'm good. I'm good. Yeah, I've been busy, real busy. Good kind of busy, but yeah, it's about time we talk about what's going on, or what our current thoughts of the day are. I know some people have asked a lot of common questions, so I thought talk about that, and I'll let you fire away.
Yeah, let's kick that off. Let's just get straight to it. One of the main questions that we've been getting, I know we've discussed this a little bit, is just about the election coming up. It's a big fall, obviously. The first debate is right around the corner. I think it's on Thursday night of this week, and obviously we know that the media and the news outlets are going to run with these stories quite a bit, and so just want to know a little bit about some of your thoughts on maybe what we can expect or how the election affects markets and some of our strategies.
Yeah, typically in presidential elections, any election, national elections, people make a big deal out of it because you have uh, they're very different policies, especially when it relates to all things economics and markets. Over time, those policies have been more and more polarized. We know that. Um, yeah, at the same time, I'd argue that we haven't seen quite the shifts in actual maybe legislation that you might expect when you have such a sea change from left to right and right to left. Um, at the same time, you've got I'd argue a very changed Republican Party where populism echoes a lot of the populism you see on the left. The economic populism is pretty similar between the two. Um, to be honest, I haven't put that much into this next election. Maybe it's just because I'm disgusted about what I see. Maybe it's because I can't imagine why in a country of 350 million people, these are the two candidates. Um, I think all things equal, neither is necessarily good for markets. Uh, yeah. Anyway, so I'm kind of down in that regard. Um, you know, but anyway, it's not our job to sort of pontificate about the world and how it should be. It's to accept what's there and try to endure with as much good humor as possible. Um, that said, we talk about it because a lot of other people talk about it, and everybody talks about it. And I guess this is not news. I'll actually show you maybe a couple of things here, if I could, real quick. Just stuff I look at on a pretty regular basis. Okay, so like one of them is just general polls, uh, not just polls from all the various media sources, but also uh, also what the markets are saying. So here's just sort of a list from 538, who monitors a lot of different polls. They by and large have showed the same story, uh, and the bottom line is it seems neck and neck. Um, that is somewhat corroborated by the futures markets. This is one of the leading, I should say, leading places people look because people put and bet real money on election outcomes. There are not a lot of contracts available, but you can see here it's statistically at least probably even. Um, you see Gavin Newsom and Kennedy and Kamala Harris, with some positive value in the price. What this shows is it's like the price, and if that person wins, you get a dollar. So Donald Trump, 51 cents on the dollar. All things equal, market says there's 51% chance he wins. Um, and then the rest of them are more or less Democrats. But these things change daily. I've been watching it for a while. I can tell you that there hasn't been a big difference. Although it seems in the very near term, uh, Biden has gained ground while Trump has lost it. So
Pretty interesting. I don't know if too many people know that you can actually bet on various elections around the country. I guess real quick. Oh, you just clicked out of it, but I was gonna say, I mean, real quick, and I guess in layman's terms, I mean, what are we looking at? Keep it simple in terms of when you pull that um election, I guess, odds data up.
it says we know nothing. So uh, we know nothing. I know I don't. But also when it seems like the markets don't know or it's a toss up, if you have real insight or you're fairly sure you know who's going to win, well, there's some ways to play it. Not just with these prediction markets, but also with certain investments. It does stand to reason, at least out the gate, certain investments will do better if one gets elected. So certain other investments will do better if another gets elected. But economically, again, going back to what I said earlier, I think the economic policies of the two are pretty similar. The talk is definitely different, but if you actually look things like trade, things like uh, their attitude towards big tech, uh, very, very similar. Deficit spending, more and more deficits. Um, no fiscal responsibility whatsoever. Uh, the only differences really, I think, are more sectors favored or disfavored, and then how to raise money. Um, tax versus um, tax versus not tax, or tax versus grow the market, or tax versus hey, let's just kick the can down the road. To various degrees. So I can't tell you there's any difference. So
What about
nice. We don't have to worry about this. I think we don't have to worry about this because this is a big uncertainty. I'd rather focus on maybe things that are more right in front of us in terms of real risk, because uncertainty doesn't necessarily equal risk. So I'll take election uncertainty. That's not the top of my list in terms of things to worry about.
sure. So I mean, I think I know the answer to this, but based on what you're saying, I mean, do you have some macroeconomic or environment kind of contingency plays or ideas depending on which way the election goes, or is it just truly kind of fundamental value analysis and in terms of our strategy over the next few months?
I think it's both. My macro is more, let's look at the things that are um, real elephants in the room. So again, instead of focusing on rhetoric and this person wins or this person wins, let's look at the things that uh, are big, are growing by the day, and are seemingly impossible to change. No matter who's president, no matter who's in Congress, we have massive year-on-year deficits. We have a massive cumulative debt, national debt, not just in treasury borrowings, but in unfunded liabilities and Social Security, Medicare, Medicaid. Entitlements is a vast majority of the budget. The discretionary part, even that's pretty slim. The real discretionary part, I think the parts of government we think where money's spent, it's a low teens percentage of the overall pie. So it's entitlements, which grow good markets, bad markets. They grow at inflation plus, and then defense spending is a big one. One other area of the debt, I mean of the spending, and I think it's just exceeded defense spending. So it used to be entitlements, defense spending, and everything else. Now it's entitlements. I think interest on debt. Now that interest rates are going up and the debt is accumulating, the annual interest, I believe, is now uh, what is it, like $1 trillion or something a year we're looking at and climbing. And then defense, which is more or less a $800-900 billion a year expenditure. So very macro, it's kind of silly to focus maybe too much on who wins when you have this sort of secular issue, this big thing that no candidate, no party is going to change anytime soon, and frankly probably doesn't want to change anytime soon. So I think I'm more worried about that. Admittedly, we talked about this before. it's not enough to sort of identify a problem and say, this is something to worry about or act upon now. And that's the thing. I mean, we don't know when this really starts to rear its ugly head. You can argue maybe it started with some inflation and higher interest rates, but I think that's sort of the biggest economic issue of our time, and going forward for quite some time is can large governments, Western governments, continue to amass bigger and bigger deficits and pay for spending with printed money? Let's be honest, that's what's happening. So I think from the political side, that I think the value of money in general is a big thing. Because ultimately you can talk about debts and deficits, but who cares? We only care when it really becomes a problem and the money goes bad. But then beyond that, you look at certain, not so much politics, but demographics is one. Big cultural, technological shifts are another. You could argue, AI, uh, AI and databases in general, not just for AI, but more and more computing power and all things crypto and all that. That is a secular, very macro phenomenon. There's energy and energy policy. There's war and geopolitics and demographics, healthcare, all that. And then you have specific things around the world that pop up. Could be game changing in a positive or negative way. I'm really fascinated by what's going on in Argentina because you're seeing a huge shift in huge political shift anyway. And I look at it as probably one of the more interesting economic, especially free markets, economic experiments going on in the world. Yeah, so that's sort of the macro thing, but I'm more focused on sort of more secular macro things. Things are not necessarily political because again, the political thing is a little too hard to figure out right now. So
Sure.
yeah, let's
Real quick,
take the
uh,
easier ones.
before we end this kind of first portion of some of the current event updates, I guess, going back to what you said originally, I mean, and touching upon the AI and big tech conversation a little bit, but what are those attitudes from both political parties? I think you said they're pretty similar. And then secondly, what are the differences in attitudes towards the various sectors? Because you said there might be some differences in approaches to that.
Yeah, yeah, both parties seem pretty hostile to big tech, and maybe there is an issue, something to be said about the largesse, the compounding, the largest of the large, these ecosystems, these tech platforms, these network effects, they've really taken over. Both parties have been pretty hostile to big tech. They've not quite as aggressive as Europe, which seems to sue them every month for something monopoly. I think Europe has really just become a kind of a highway robber. Every year they come up with something and they get a multi-billion-dollar settlement, and people advance. They go from competition committee chair to head of the EU even, or at least that's the path of these very much career politicians. Both his sides have come at him, I think, for a lot of similar reasons, but they're also just you can argue, you can be reasonable and thoughtful and say, hey, this is something to think about. All things privacy, for instance, and not to mention what are the downsides of big ubiquitous tech platforms. Is social media the latest and even a worse version of big tobacco, things like that. But in the markets, same, big tech has been the ball game. In hindsight, it was like, yeah, just buy some big tech companies and take some volatility. But in the end, these $100 billion companies become $1 trillion, become $2 trillion, become $3 trillion, and just comprise a bigger part of the market. You can see we've sort of exceeded the .com even in terms of the concentration at the very top.
Yeah.
Again, it's not not saying it's a bubble. I mean, there's obviously some things very bubble-ish. I am a little, I get a little, I get a little worried when people come out of the woodwork, and non-stock people, non-investment, people don't have the slightest interest in investments, and all of a sudden they come with, what do you think of NVIDIA? Let's buy NVIDIA. Um, NVIDIA is a great company. I wish I had. It's something I found in a long time ago, and for one reason or another didn't invest. I remember that company when it was like $7 billion market cap, and now it's the $3 trillion. I mean, it's amazing. But not all of this is bubble, because they are big profitable engines, and that's the big difference between now and the dot-com boost boom and bust, was that they do make money. Oh, I forgot this. So, a real nice time we're having in terms of like investment weather. We've gone quite a while since the last 2% down day. I just thought I'd bring this up because I remember thinking, hey, it's been a long time since we've seen some real volatility. All the volatility indexes are down. In the fund, I'm looking at ways to, basically buy volatility, or basically hedge by going long volatility. But I didn't realize how, I guess what I kind of already noticed or felt. I didn't realize when you quantified it how pleasant the weather's been and how low the volatility is. So yeah, this will change at some point. I was going back to, so the biggest of the big, I mean, they are growing earnings at a faster pace. And so if you sort of compare large cap earnings, or at least earnings estimates, of big tech versus small cap, and these kind of represent 3 different years. So the blue is 2024 estimates, the orange is 2025 estimates, and at the top, 2026 estimates that at least Wall Street has. Wall Street is basically predicting growing earnings, especially over the 2-year period for large cap, but at small cap, earnings compression. And I guess maybe, I know you had some questions about the large cap, small cap thing, and
Yeah, I
I
mean, I
certainly have
think
a take on that.
a lot of people read and think that large cap companies are just a little bit more immune to higher interest rates for longer. Obviously, they typically sit on larger cash reserves. They can earn a little bit more on that. And then depending, and you made a good point on sector differentiation, and depending on how capital intensive the businesses are. Sure, some smaller medium cap might be hit harder by the higher interest rates for longer, but not necessarily. So that was a big question that I've had. Yeah, so just talk us through that real quick.
Yeah, so traditionally, a lot of strategists looked at large cap versus small cap. They have gone in multi-year cycles over longer periods of time. If you just look at the numbers, smaller stocks over time have outperformed larger stocks, which is maybe kind of predictable, given that maybe smaller companies are inherently more risky. At least they are, or seem to be, from a trading standpoint. But I'd argue that the sector composition between large and small has really changed. Like I said, we're very concentrated at the very top in technology, but that also means that a bigger and bigger part of the market, or at least the S&P 500, the large cap space, is more and more tech. You look at small cap and small caps in general, their sector and industry weightings look really different. Tech is not a big part of small cap land. As I look at small caps, you see a lot of
Banks, regional banks.
Yeah, banks, regional banks, utilities. You see a lot of small, like oil and gas operators. There's a lot of, frankly, unprofitable companies in small cap land. You got small cap biotech, and this and that. So certain sectors, you have a lot of smaller companies naturally, one way or another. You don't have, like, let's say, take consumer staples. We think of Procter and Gamble and Clorox and things like that. You don't have a lot of small cap, or at least over time, you don't have a lot of small cap consumer staple stocks, or at least ones that done well. Consumer staples is very much a large business. They're large in scale, or they bust, or they sell out to the bigger Procter and Gambles of the world before they can really grow, and investors can get years and years of compounded returns. Arguably the same with tech nowadays. So, I look at small cap land, and even though all things equal, I'm more interested in the small mid cap space because they are sort of, I think, being largely ignored. Especially in a time when the prevailing wisdom is, hey, just buy NVIDIA and go home, or go to sleep for 10 years or 5 years. So I think some of the more exciting picks have been, and we talked about this, smaller companies, but with a lot of the attributes that people like in some of these large cap tech companies. Like you said, growers, not capital intensive, companies that are naturally growing because they have a great product or service. I think those are not only great investments over time, but I think the risk reward on them is probably underestimated. So I don't look at large cap versus small cap, although, like all things, if you sort of strip away and take out all nuance and just isolate to one factor, yeah, there is something to glean there and something to think about and learn about. But I think in our industry, that the tendency is to think of one thing as a sort of a big homogenous thing. Large cap is this, and small cap is that.
Yeah,
And I don't think that's
I'm
true.
happy. Yeah, I'm happy that you touched upon the differences there, because I think we can, in the investment world and society, we can tend to just group all of these different types of companies, no matter what the sector is, and throw them into these baskets without necessarily peeling back some of the layers, important layers, when it comes to analyzing, each individual business itself. So, you there?
Yeah, I'm here. I'm just trying to think, okay, takeaway. What's the moral of the story? Moral of the story is, we are quite an extended period of what's been a huge super cycle, a super cycle that is now faced with higher interest rates. Those interest rate expectations seem to get more and more extended out. So when you have a large interest rate campaign on the upside, it tends to eventually squash markets, especially ones that have enjoyed a really big run and now have pretty high or above average multiples. But again, it hasn't broken yet. We talked about this before getting on camera. We seem to be in overtime, but this could continue going up. I don't know. I just know how I want to play it right now, and which is, as these things really start to crescendo and charts, like this start to look more and more parabolic, my instinct is to take more and more of general stock exposure off the table. And as interest rates go up, park it more and more in, low to no risk liquid bonds, and just collect an income and be happy with 5%. Rather take a low to no risk 5% than a very risky 10 or 15 even. Especially for the bulk of the money and the strategies that they're in. Again, that's more of a near term judgment, I guess. Long term, I think stocks will do just fine, or at least continue to hedge inflation and then some. Why do we invest in stocks? Not because they've done better than just about, I think, every asset. They have done better in every asset class historically. I think you're long stocks because of a couple of things, including, this is a system that still really rewards investment. Right? You have property rights, you have rule of law, which is absolutely necessary to capture the second thing, which is, human capital and human capital compounding.
Sure.
We can talk about compounding in terms of, general inflation or real estate or other things that compound. But their growth is maybe subject to a couple of things, right? You got to have certain square footage. You have to have certain per year rents per square foot, all that. Very linear type of thought process, I guess. But with human capital, there really aren't any constraints. And look at the few $3 trillion companies we have out there now, just as sort of evidence of sort of the joys and the beauties of really great products and services and things that people come up with, and capitalism doing what it does. I think that's still in store long term, so I don't want to poo-hoo stocks, but near term, I definitely don't want to be out without an umbrella. If there's a chance of rain, even if few people think it's going to rain, I just look at it and say, okay, what's the cost of being wrong? And I'm willing to just carry an umbrella, maybe make a little less money in the near future, so that if almost everyone's wrong, it could be a really big payday, not just by saving money, but being able to pluck bargains left and right.
Sure. All right, Neil. Well, thanks for the update. That was awesome. We touched upon a bunch of different topics. Let's get back on here again soon and jump into a couple of more, and we'll release some more over the next few weeks. Thanks for your time.
No, thanks a lot. And hey, remind me, we got to do something on uranium. I want to talk about it.
All right, sounds
All right.
good. That's
Thanks
a
a lot.
topic for the future.
Okay, thanks.
Bye.